Good afternoon, everyone. For this meeting, me and my evaluation team with an average experiences of 3 years in financial analysis would like to share with you our analysis of the potential acquisition of Sun Microsystems. After conducting a thorough valuation of the company, we believe that it has a significant strategic value for our organization. So in the next 10 minutes, we'll walk you through our analysis and present our recommendations.
All right. Our team is currently evaluating the value and worth of the company, taking into consideration various factors such as its customer base and market trends. However, we have faced competition from companies like IBM. IBM have also expressed interest in acquiring some Microsystems and have valued the company at $9.4 per share. In response, we have made a higher offer of $9.5 per share. And we have observed that Sun Microsystems, while having been a successful company, has faced a downfall in the past 2 years and is almost taking a bear. Despite this, we believe that the company still has a significant customer base and could prove to be beneficial to the acquiring company. Based on that, we will continue to focus on all aspects of the acquisitions and provide further analysis to determine if the investment will pay off for the company.
There are 3 different methods through which we can evaluate the company's worth: the weighted average cost of capital and valuations with income and market approach. In the case of Sun Microsystem, we made a few assumptions of the risk-free rate of 2.82%, a risk premium of 6%, and an average tax rate of 35%. The company had a WACC of 10.85%. This means that the company must earn a return of at least this number on its investments to meet the expectations of the investors. If the company earns less than this, it will not be able to create value for its shareholders, which is us possibly in the future. We can see that Sun Microsystem has a higher WACC than the median WACC for the group of hardware companies provided. This indicates that the company may be considered as a riskier investment than some of its peers, as it has a higher cost of capital. So in the M&A scenario, we will take that into consideration to see if this makes the company less attractive compared to the other companies with a lower cost of capital.
All right. We also use direct cash flow valuation to test a reasonable price for us to acquire the company. For base case cash flow, we include revenue, operating expenses, capital expenditures, working capital changes, and the taxes. We also calculated the WACC before, which is 10.85, and based on the market condition, we believe that the growth rate will be 2.82 and tax rate will be 35. Based on these assumptions, in the no synergy condition, we calculate that the company has a terminal value of 10,977 millions and a present value of future cash flow, free cash flow to the firm of 1,500 millions. The present value of terminal value is 6,000 millions. So the enterprise value, which is EV, is 8,000 millions. The equity value is calculated as 8,000 million based on the EV. The price per share is then 10.83 per share. With same assumption, we calculate that the Sun Microsystem has a terminal value of 18,000 millions and a present value of free cash flow to the firm of 1,800 millions. In the present value of terminal value is 10,900 millions, resulting in a enterprise value of 12,000 millions. In the equity value is calculated as 12,000 millions. So the price per share is 70.16 per share. Based on the DCF valuation, it appears that it is a good acquisition for us, as the estimated equity value based on the terminal value and the present value of free cash flow to the firm is higher than the acquisition price per share. However, it is important to note that this is based on certain assumptions and calculation, and there may be other factors that could impact the actual value of this acquisition. It is important for us to conduct through due diligence and consider all relevant factors before making a final decision on the acquisition.
And we also use the market approach to analyze. It is based on the comparable companies in the public traded market, using their financial data to do the evaluation of our target company, the Sun Microsystem. And we chose 6 comparable companies in the Sun Microsystem's similar market, and the companies are shown there. And then we calculate their EBIT, their EBITDA, their sales, and PE's multiples, which are 9.47, 7.09, 1.29, and 11.03 respectively. And after we got the multiples, we use the data from 2007 and 2008 to calculate the EV, the enterprise value from the multiples. And since we use 3 methods, the 3 methods gives us 3 relatively different number, and we took the average of this 3. And finally, we got the result that the average stock price should be $12.2, which is higher than the $9.50 in the deal. And similar to the DCF approach, the market approach gives us a positive result that 9.5 is a relatively good price, room for negotiation. And however, the data we use is only in the year 2007 and 2008. And as mentioned before, there is a big drop in the revenue in 2009. And this big drop is not accounted into this valuation method, and so that using the financial data in 2009 would cause a relatively big change in the valuation by the market approach method, because it is not reasonable to compare a huge negative operating income company to the company to compare it to the company like Apple, Dell, or Intel.
Overall, based on our analysis, we recommend that we move forward with acquisition price of 9.5%. And we believe that this acquisition will bring strategic value to our organizations and generate strong returns for our shareholders. However, the maximum price we can take is $12.5, because going above $12.5 per share would also increase the risk of overpaying for the company, which could negatively impact our returns and overall financial performance. Thank you for your attention today. If you have any questions or would like to discuss further, we would be happy to chat after this presentation. Thank you.